Why not?
It's not real. It's a ticking time bomb. It's like sitting around in a circle throwing around a hot potato. I mean, every year I mean, that's what it is. You're the last. The closer you get to expiration, the hotter the potato, and you're the last person holding it. You're not gonna be able to sell it. So every year, the taxes are you start to phase out, and they can go up.
All right, so we're back at the IPRG Roundtable, and we're doing this podcast. This is the third episode, and we're sitting here talking about stuff that we're seeing in the real estate market in New York City that's interesting to us. We talked about interest rates and rents. We talked about IPRG and what the company's all about. Today, we want to talk about a new trend that we're starting to see throughout, throughout Brooklyn, but it's happening all throughout New York City and all throughout the country. But what we're talking about today is institutional capital buying predominantly small properties in Brooklyn. So where do you guys want to kick this off? I mean, we're seeing some new buyers enter the market, either as limited partners or buying direct, and they're putting together portfolios in some cases of smaller, tax class 2A and 2B tax class protected properties. So yeah, Luke,
I'll
kick it
off. You just brought it up. I think let's start the conversation. I think the most interesting thing that's happening and why we're having this conversation is we are seeing institutional buyers buy small buildings. When I say small buildings, under 10 units. And that, to me, is something that we've never seen before. It's a space that we've always been extremely active in as a group, but we've never seen this caliber of buyer execute as much as they're starting to really execute. So I think it's really interesting.
Okay, so let's dig in there. So you say buying small buildings under 10 units.
Yep.
What is the appeal within this asset class? Why small buildings? Why aren't they buying bigger buildings above 10 units, like 11 units?
Well, I mean, I think that really came down to just the 2019 rent laws, and once the rent laws hit, obviously there's a big pullback from rent stabilized properties into the free market asset class. So that was sub 6 units. Obviously, at that point, the supply and demand of individual apartments was really constricted because people weren't really incentivized to renovate the vacant rent stabilized properties. Mm-hmm. And so there's been a huge shift in demand towards the free market, and that obviously increased the rents. And therefore, obviously the institutional investors have really gotten behind it because they see a lot of rent growth.
But we're saying two different things
the
here.
question.
Yeah,
I got the question.
We're saying two different things. I asked why they're buying a 10 unit or a 9 unit and not an 11 unit. But correct me if I'm wrong. A 10 unit building or a 9 unit building likely still has a rent stabilization component to it, or does it not? So, I get it with if Adam's talking about buildings under 6 units on the multifamily side, that's a different story altogether. So is that what we're seeing? Institutional buyers buying 2, 3, 4, 5 unit buildings?
Free market buildings, I think.
Free market.
Yeah, that's why you get the under 10 units. And they wanted to have the protected tax class status.
See, I disagree. I think the reason why they're doing it, and I agree with what you guys are saying, obviously, small buildings, they're free market. I think all these guys these groups that are buying these packages, they are free market, they are renovated fine. But I think it's expense control. I think that's what they're doing. I think they figured out that these buildings have artificially low taxes. They have low expenses. They're really easy and predictable. You know what the heating bill is going to be. You know what the electric bill is going to be. The insurance. It's very, very small, and you could quantify. It's easy to put a number on it. And they're saying, okay, I can make money here. And obviously, these are big funds, and they need to spend a lot of money, so they're going to buy a lot of buildings that look like this. But I think it's predictable expense control and income control, and they know what these buildings can make, and then they times it by 200 deals, and they have a nice little package.
So are we seeing institutional capital buying rent-regulated 8-unit buildings? Is that what we're talking about? I know free market has come up a number of times in this conversation, and above 6 units and above becomes rent stabilized, and under 6 units is free market. But are we talking about rent-regulated, free market? What about the mixed personality properties that are 50-50? Or some combination?
I'm just seeing them stay far away from rent stabilization. I think they need to, what Luke said, the expense control plays a factor, but I think they're looking for the rental growth in these areas because New York City housing there's a crisis and there's a shortage, and I think that's what they're targeting to exploit. I think they have a competitive advantage. This is usually an asset class that we've had difficulty finding a large buyer pool over the years, and they've come in and they've exploited that.
I think Luke. I'm more on Luke's side here. I think Luke is dead on in terms of expense control. I feel like where, on the tax class 2 properties, the taxes have been going up so much, and you don't know what the cost of heating is going to be and the cost of whatever the other operational expenses are. But on these smaller buildings, in many cases, if they're renovated, the heating cost has been pushed onto the tenant, so you no longer have that expense item. The taxes are fixed. They can increase by 8% per year, but on most of these buildings, that's like a very small number. In many cases, it's $1,000 or less per year. So you don't have the real estate tax increase exposure. I understand and I agree that a lot of these institutional buyers want free market, but that's not across the board. I mean, we know of portfolios that are under contract right now, probably valued in the range of $100 million plus, that consist of tax class 2B and 2A buildings, but those are not entirely deregulated. Those have rent-regulated apartments in there and destabilized apartments in there. So I think I'm more on the side with Luke here in terms of they're trying to get expense control, and other funds are looking for only free market. And they want to have the potential to have the growth on the way up. And I think for the funds that are able to execute on acquiring free market units in this, segment of the market where the buildings are smaller, they understand the expense control, that's like the perfect type of property if you can group a portfolio of those buildings together.
What's interesting too about these funds, I mean, they're pros at raising money and they're pros at deploying money. And most of our clients are historically buying these small buildings. I mean, they're not buying at this level every year. They're taking on debt from traditional banks and lenders, and they're raising, money from a few high net worth individuals, or maybe it's like a family office. And now here comes some major funds, and they're raising capital at way cheaper amounts, maybe overseas, maybe not. So a cap rate for them that might be a good deal and work their business plan is much higher than the normal buyer, and they have that advantage. Mm-hmm. Yes, historically these funds can be a little more difficult to deal with, but their money makes up for that in their prices, and they have a huge advantage. They have a huge advantage, and these buildings are special, and there's a reason why we sell a lot of them. I think that it's a good way to make money, and like the expense control is big on buildings under 10 units or 10 units and under, and they're exploiting that. And I think they have a huge business plan here, and they're buying in markets where they see a lot of rental growth, and there's still a lot of rental growth to come.
What markets are these?
So if we're talking about Brooklyn, I think Brooklyn as a whole, there's going to be a lot of growth, but areas like Bushwick, Bed-Stuy, Ridgewood, which is basically a little extension of Bushwick, Williamsburg, Greenpoint, areas around Prospect Park, Prospect Lefferts Gardens, you have, Prospect Heights, Cobble Hill, Park Slope, all these areas.
So, all right, so these institutional investors come in and they're trying to put together portfolios, $100 million minimum.
Yep.
And we're seeing them do this piecemeal with small properties. But, I was reading in The Real Deal, Blackstone recently bought a building in Lower Manhattan. They paid $980 million for it. And I think it was a 76-story property. Why not just buy like one big building in one fell swoop instead of, cobbling together all these little deals?
Management. So, sorry to jump in, but management is everything in real estate. It's a big part of it. And if it's a big deal or a small deal, if it's managed incorrectly, you're not going to make money, and it's not going to be right. So a Blackstone, my guess, I'm not speaking for them, I don't know anything about them, but I'm assuming that they don't have the capabilities to manage 200 small buildings in Brooklyn. They probably have the capabilities to buy a beast in Manhattan, and that's what they did. And these funds they're buying. These funds are buying in Brooklyn where we focus, and they're buying the small deals. They either have the management component on lock, or they're injecting funds into syndicates that have the management on lock. So management's a big. If you're gonna start buying a bunch of small deals, management's 80% of it.
But why would a fund want to buy all these small deals when they can just buy like one deal for 500 million or 900 million? And I'll give you a different example. KKR came in a couple years ago and they bought the Joseph Brunner portfolio, which is 14 buildings, and they paid 860 million. So you have funds like Blackstone, almost buying $1 billion worth of property in one fell swoop. KKR buying 860 million of 14 buildings in Brooklyn, one fell swoop. Why are we seeing this trend towards like smaller, individual assets?
Yeah, so I think when you're investing in a stock portfolio, you want diversification. And I think if you're able to buy and gobble up 100 buildings in different locations, you're diversified across the market. So if there's rental growth in Lefferts Garden, for example, or Bed-Stuy, and you only own in Park Slope, for example, you're not going to get that bump. But if you have 100, 200 buildings that are already got renovated, scattered across multiple markets, you're diversified across an entire borough. And effectively, at some point, you'll actually control pretty much the entire inventory of the renovated product in that location. So if you actually believe that there's a trend of people that want to spend a little bit more to live in a nicer unit, and you control that entire market, if you can increase the rents by $100 across 200, 300 buildings, the cap rates across the entire portfolio and the return to your investors is far better. And that's why I think they were doing it.
I think it's spot on. I mean, diversification, and I think it's their competitive advantage. They're exploiting a building type where I don't think they have any competition. It's basically institutional versus local family office, institutional versus syndicates. There's no one at their level competing with them. They are basically going to dictate the market today and for the future with this asset class.
So I have a different take on it. I hear what you guys are saying, but for me, all these bigger portfolios that these funds have bought on the multifamily side, so they want renovated units, okay? They don't want old pre-war rent stabilized units. They want renovated product. The issue is on a larger scale, all the renovated or new construction product is 421A product. So you have all these buildings, whether it's the building Blackstone bought or the KKR stuff, these are all 421A properties. So you do have a rent stabilization component to those. On top of that, you have a massive real estate tax increase exposure, which is going to come down the road. So what's interesting about these funds buying these smaller buildings, they're basically picking and choosing what they're going to buy, but in some cases, they're buying completely gut renovated product. So they're getting the renovation component, they're getting the free market component, and then on the smaller scale, they're not buying J51 properties, they're not buying 421A properties, so the taxes are fully baked in on tax class protected product. So they're basically getting all the renovated units and all the free market units that you'd be able to get and buying some big new construction building, zero rent stabilization, only free market. And you look at if a fund is able to come in and get enough of these buildings and enough of these units together in these Brooklyn growth markets, and you have the real estate tax cap, basically all of a sudden you're getting the best group of units available in New York City, and you're putting a portfolio together that can't be replicated. So I think these funds that are coming in are literally putting together the best group of units and the best overall real estate structure in terms of taxes and expenses that you can possibly have. And all of a sudden they have a portfolio of just the best product available. So I think that's been one of the most interesting plays here.
Yeah, and beyond that, if we're gonna go walk 100 buildings, right? I'd say 90% of them aren't renovated. So the actual, I don't know the statistics on this, but the renovated versus non-renovated product, I would say it's 90% unrenovated product that if people actually went in and gutted and stuff like that, that 10% is gonna be so valuable in the future because a lot of people don't want to put in the work or deal with DOB or the construction, as Luke's talked about, because it's a huge headache and because you have to be a sophisticated person to actually go in and do the work on these units to make them nice.
And I think a lot of these syndicators that we've sold a lot of deals to in the past and still do, obviously, I think some of their investors probably got a little burned, right? I think some of these projects took longer than they thought they were, or they got tied up in the purgatory of DOB and they can't get the sign-offs and all this stuff. And you're going to continue to see people just wanting finished product. Everything signed off, everything done. Because there's real value to that. Renovating deals not only takes money, but it could take a lot of time, and there's a time value cost.
I was speaking to a developer not too long ago, and he was basically saying that the price that some of these developers are exiting buildings at, so basically where the funds are paying for properties today, he was saying in order to get a building, get it vacant, redevelop it, the cost of capital, the time to get there, the cost of construction, that you're going to be into the deal for basically what these people are paying anyway. So like the cost of construction has gone up so much. So there's like an arbitrage aspect on that too. And they're getting all this renovated product arguably for below replacement cost in some cases.
So why are they the only ones paying these prices though?
Who's they?
These institutional funds, because I know we're having conversations with sellers. There's the institutional price and there's the price of what the property's worth.
Well,
and there seems to be a big spread.
I mean, Luke mentioned they're raising money, in the U.S., in some cases abroad. I think there could be currency arbitrage in some cases. I think these institutional investors have access to capital at far lower rates.
So I'm so sorry to interrupt. I didn't mean to, but they are pros at raising money and deploying money. This is what they've done for a long time at very, very, very high levels that the normal Brooklyn investor can't even fathom. So they have that on lock. So their returns aren't other people's returns. Their cost of capital is not anyone else's cost of capital.
I wonder if it's a play or a spin off the single-family rental game. I mean, you've seen it across the U.S.
Blackstone's been doing that for years.
They're the largest homeowner.
Yeah.
Why not be the largest small building owner in America?
Dixon Advisory was the first one to do this in Brooklyn. They came in and they cobbled together this whole townhouse portfolio of 1 to 4 unit buildings. They had the cost of capital based on Australia. They had their REIT out there. Who knows what their cost of capital was? And some of those townhouses they've sold. Some they still own. Beautifully renovated, renting for very high numbers.
What's interesting, same neighborhoods you're seeing today, though.
That Dixon started in 2013, 2014.
They were buying the brownstones in these same neighborhoods where these funds are now buying small multifamily renovated
So you're
buildings.
saying Dixon was like ahead of the curve in that way?
Well, ahead of the curve, but it's interesting that they're going in the same markets too. Because you can pretty much buy these small buildings all over the city.
And they're paying, and everyone thought Dixon was paying all these crazy numbers, the brownstone prices, all that stuff they were doing in Jersey City, and Hoboken. Those deals look very good right now. And they did beautiful renovations. They're crushing it.
And I remember like earlier in my career when like we were looking on Streeties at the renovations, they were getting $15,000 for a duplex and Cobble Hill. I was like, oh my God, like this is insane. Right. And then like the 2-bedroom was going for $3,000, but somehow they came in and they saw the opportunity and there's just so much market demand for nice renovated product from renters. People are willing to pay a huge premium for that, and there's just not a lot of it in the market right now.
So that brings up an interesting point. So Dixon came in and they got renovated to their specifications. They built the product in these townhouses that they wanted, and we know of other institutional investors that are coming into the market now, and they have general partners that are handling construction, and other institutional investors want stuff that's just finished, signed off, permits are closed, don't have to lift a finger. So like what's your guys' read on that? Like a institutional investor coming in and doing the work themselves, or partnering with the general partner to do the work and get the product from point A to point B, or just buying when it's already done?
I don't think you'll ever see them doing the work themselves. I think what they're doing, and what we've been seeing for a few years, they're finding operators that operate buildings and buy buildings and have a face and a name in the market. They're giving them money, obviously, to buy deals, and they're running it. But there's institutional buyers buying value-add multifamily and mostly value-add free market deals. It's been happening for the last few years. It's happening a lot this year, last year. It's happening, but they're not doing it. An operator's doing it, and they're just giving them the money. But you'll never see I don't think you'll ever see a fund come in and be a fund, or it be an institutional capital fund and do everything A to Z. It's crazy. Maybe.
No, 100%. No, there's some operator.
Yeah, there's got to be an operator.
So when you say they're buying free market value add, like I have a couple deals that come to mind, but I'm thinking 2 over 1s, 4 units.
Yeah, these small deals. we're doing a deal right now, you and I, so we'll talk a little bit about it. It's a 4-family in Greenpoint. We're selling for a big number that was bought by institutional money. That was bought for a number they thought was a good basis. They got renovated and they're selling for a premium. So that was
to a different institutional buyer. So the point is, that was an institutional deal from the start. It was bought, operated, and got renovated by a player in the market that's backed by the institution, and now it's being sold to another institution that's paying top of the market for a renovated product. And what are we seeing in terms of like cap rates on this stuff? Like, do cap rates play in? Is this yield based? Is this price per foot based?
It's all yield based. I don't think it's price per foot's a very important metric, but it's not so much important to these guys. These are yield buys. Mm-hmm. So I think it comes into play big, but their yield requirements are not the average market requirements. So to Steve's point, that they're like, I don't get it. There's such a spread. It's all about the cost of capital.
Yeah. It's their competitive advantage.
Their rate, I'll tell you this, they're probably making more money off that rate than the other buyers making off their rate. They're just getting that cheap a debt. They're doing it for a reason, or equity. I'm sorry.
We just put a gut renovated 8-family Park Block, Park Slope in contract for over $6 million, which is a massive number. And the metrics are like, it's like a 4.5 cap at $1,400 and change per foot, which is huge. And the building's like less than 20 feet wide. It's pretty incredible what they were able to pay and make money on versus the other investors who weren't going to be able to pay close to 5.5% cap on it.
So you basically think that this property we sold sells for big numbers. Is this what I'm hearing?
Yeah.
You think it sold for a low cap rate and a high price per foot?
Yeah.
And you have an incredibly sophisticated buyer, I'm presuming, on the buying side. So, like, what's the play for them? Why are they buying it?
I think it's a timing thing. I mean, if you really look back to see when this all started happening, it was pretty much right in 2020, 2021, going into today. And what you see today is high inflation, high rents. I think there has to be some kind of rental growth play.
Yeah, it's a rent growth play.
And I think they all have their models, and they might be getting cheap capital. But I think they're planning on a big exit when the rents are going to probably be anywhere from 50% to 100% more than they are today.
And not only that, like they are going to control the entire market for free market renovated product.
It's true.
And at that point, they're like, oh, you want this nice renovated
like
product?
Operational efficiency.
Here's another. You have to
market
pay me
intelligence.
pay me another $700 a month for it.
They'll know what the rent per foot is, the rent per room. They'll know all the trends that tenants want. They'll have every advantage. They'll be able to get the best management costs, the best costs of any type of service needed on the building. So they have all these massive efficiencies. Their cost of capital is so low, so even if they're paying a compressed cap rate, they're still making a nice yield, a nice spread, a nice IRR. And Steve mentioned something about the exit. So yeah, I was listening to a different podcast recently. They were talking about just deploying capital, buying companies on an institutional level, and they're basically saying that most investors are looking for like 10 years to put out the cash. First 5 years, you're putting out the cash. Second 5 years, you're just letting the investment ride before you exit. Do you have any thoughts in terms of like exit strategy or hold period that funds might be trying to execute on?
I think it's a hard. I don't think we're gonna know. I mean, obviously they know. I think they have ideas. People say
Too early to tell.
People always throw out like a 10-year hold or a 5-year hold. I think it depends. When they feel like they can make money on a sale, they're going to do it. And I think it's all about the rent growth. I think right now, I live in Manhattan, and I know the rents in Manhattan, and there people can say, oh, there's the rents are so inflated in Brooklyn, but you know what? It's a huge discount to Manhattan, and if you think areas of Brooklyn are just as good as Manhattan, then you're answering your own question, and you have a lot of growth.
I think it's actually like an incredible trend for the average professional guy. Like historically, when these guys were coming in and gut renovating buildings, like the exit was the elusive 1031 buyer. And now the exit is like, yeah, you still can get the 1031 buyer, but now there's a very clear business path to exit to these well-capitalized funds, and you're almost pretty much guaranteed after you do the renovations, get the sign-offs, it's as clean as can be, you can exit.
Let's dig in here a little bit, okay? I want to talk about this. So you're saying that the regular investor has a clear business plan to exit to an institutional investor.
Yes.
So what does the product type have to look like, and what does the exit look like for your everyday developer, investor, syndicator, not an institutional player? How do they exit to these institutional funds? What do they have to do?
I think either buy in the neighborhoods they're buying,
Okay.
which we touched on before. I think the buildings have to be either vacant or free market that needs renovation with upside under 10 units.
Or
I mean, obviously everything Steve said is correct.
Yeah,
but
correct.
You have to know what you're doing, and you have to educate yourself. Knowledge is everything, and education is everything with this stuff. And there's plenty of people out there that know this stuff cold, whether it's DHCR law or rent laws or how to do a substantial rehab, whatever it is. There's people that can do it, and if you're planning it to sell to them, make sure you know what you're doing. Make sure from step 1 to step 10, you're hitting everything so that they buy the product.
step 100.
Yeah, step 100. If you make one mistake, you're out. If you notice something in the basement and you look over it and you think there might be some structural issues, if you don't get that solved, you're spend the extra money. That's all I'm going to say. The people that spend the extra money let's take the funds out, take the raised capital out. People have always buying finished product. That's always been something people want to buy. Obviously, the people buying now are a little more difficult and they want everything to be perfect, but it's always been the way. So if you want to sell finished product, spend the extra money. It'll always sell. It'll always go for a premium, and make sure you're doing the work right. That's what I would say.
So we basically said you have the vacant buildings that as a developer, as an investor, that you could go buy a vacant or try to get a vacant building. And then you're saying basically rehabilitate it and renovate it and do all the work and then sell as finished product, or, right?
Yeah,
And you're saying the value add, so it's similar. I'm guessing that's an occupied building where you think there's rent growth and you can go in and renovate and add value. Or as Luke is describing here the finished product, which is where someone vacated an entire building or most of a building, went in, got renovated, got permits. In some cases, he mentioned substantial rehabilitation. So these are the avenues for the current investors in the market to basically capitalize on the institutional capital coming to the market.
And that's where people make money, right? You sell a vacant building, you're selling to a pro, right? You're selling to someone that has a business plan to make money. Okay, you sell a gut renovated finished product. There's a lot of buyers for that, and depending on finishes and how good it is, like you can make a lot more money, right? You see it all the time with homeowners, right? Like you see condo developers do these jobs. Like we all know what it costs. Maybe it's a good renovation, maybe it's not. But finished product, there's a buyer for it, and they're gonna overpay. They're gonna overpay.
I think what people forget though.
Yeah.
People are willing to pay for that work done.
Of course.
There was
There's
not
a
this
premium.
there was not this demand though, just a couple of years ago, right? We used to get a finished product deal with no juice, no upside, and be like, who am I going to sell this to?
So let's talk about
yeah.
that for a minute,
So,
because just on that point, real quick, sorry to interject,
Yeah.
but we had that building in Weirfield, which is a 7-unit, gut renovated, no J51. I think it was an Alt-1 conversion, free market, and you did an amazing job selling that. But who was the buyer profile back then?
It was a woman out of New Jersey who won the lottery.
Yeah, she won the lottery.
She won the lottery and she was looking to buy finished product with no management.
I bet she could sell that building now and exit it. Although at the time we felt like she was a very hard buyer to find, and she paid a very good price. And
Very good price.
The seller was a very sophisticated and sizable landlord in the city, and they couldn't have been happier with us.
The reason is because most buyers, especially in Brooklyn, buying small deals, are doing it to try to make money.
Yeah.
You can't make money buying finished product. It's more of like a long-term hold play. You could say it's a cash flow play, but you're basically like you're looking to park money, and you can't make money parking money, or not the rich that these people
So then why are the institutional buyers doing it?
Because there's a piece that you're not understanding, or I'm not saying you, but the piece that we're not discussing is the money they're getting. They're getting money at a cheap enough basis where they could buy these returns, where their returns hit, and I think they're underwriting to huge amounts of growth throughout the rents in the next 10 years. That's why they're paying it.
And they have the scale.
Yeah,
and
then
it's
it's-
a
it's-
And,
it's a scale.
and on top of that, they have the connections with all the financial institutions and capital sources out there, and they know what they can sell at for exit cap rate, which is probably with all these units together in this perfect deal profile. I'm sure they could sell that for a premium.
Yeah, and it's all about economies of scale, right? So if you're, if they have a rental broker who's going to be charging them X fee for one building, but you're like, hey, I'll give you 500 buildings to go and rent out for me, like, boom, the broker fee's cheaper, right? In terms of the super, you have a guy that can manage one building, he can manage 30 buildings. You're going to get the economies of scale benefit there and be able to pay cheaper wages to make the underwriting on the transaction more effective. And I think that's why it'd be really interesting.
You also know their return requirements. They're probably not as the person buying a 6-family. I'm going to gut it. And I want to double my money. I mean, they're probably not looking to do that. They're probably looking. They're comparing it to their other investments and they have a certain model.
I mean, this might be a little bit off topic, but the institutional investors basically changed the game. So historically, like if a building was vacant, like it was a very clear path to gut renovate it and sell to a user or condo it out. Like A to Z, it was very clear cut in terms of what the developer is going to go in, gut the building, his exit, on to the next project. And with the new institutional investor coming in, that same business plan is now there for just rental buildings. And that's what's changing the entire landscape of the market right now.
And think about it too, when you renovated a deal, you banked on that cash out refi, most of these investors, right?
Yeah,
definitely.
Rates were at 3% at the time. You got huge numbers. A lot of these guys over leveraged and they just wanted to keep moving money. Today, you almost got to look at it as a sale, where that wasn't the case a couple of years ago, because you might get, you probably will get more
You're saying
equity.
someone's going to...
If you renovate that same 6-unit, you're not going to get that huge refi that you would have 3 years
with
ago.
where interest rates are.
Where they are today.
Yeah.
So your best option is to sell, move the money that way.
I'd like to touch on something Adam said. Adam said they changed the game, and Adam said that they used to develop and then sell to like a user as a condo. So let's talk about that real quick. What about the guys that went in and bought townhouses for like a 3-unit condo, a 4-unit condo, and interest rates are up? I'm reading that the housing market has slowed down, the condo market is down. Are we seeing examples where someone may have wanted to like build a condo project and that was their plan, and all of a sudden it's turning into a rental play where they're going to exit to one of these institutional investors?
I think, yeah, absolutely. I think we're seeing it right now. Like we just submitted, a mostly finished condo quality type of product to the fund. And obviously the investor's saying like, hey, like if I can get out of this thing in one full swoop to a fund at a low, yield versus go through all the broker fees and selling off the units and all the additional debt service that they're going to have to service while it's just sitting there vacant on a condo play. I think a lot of the developers are also looking at this as well, and it's a diversification play for them as well.
I think
if the condo market continues to flatten or even decline, it gives them the ability to exit another way, which I think is really interesting.
Especially in some of these other markets, like take a Bushwick, for example, right? There's a ton of condo developments going on. They're building better product than rental product. They're selling this product, so it needs to look good. The facades need to be brick and looking good, and the appliances and the floors and everything needs to be on point. And if interest rates go up, and which they have been, the condo market in these areas is going to be really affected. And because these people are buying condos for $500,000-$700,000, and a point in interest rates is a big bump in their monthly payment, and the developers know that, and they're like, okay, I'm better off selling it directly to somebody, pay one broker fee, get it off the table, off the books, and they know that these condos are going to sit. And
No, go ahead. Sorry.
and the rental market, they can hold it for rentals, but that's not their business. They're sellers.
So
They're not going to hold a building for a rental play. They don't have the infrastructure.
So I have a couple interesting things that I think's come up in this conversation. So Luke says in Bushwick or whatever, you're selling condos for $500,000 to $700,000.
Yep.
I believe that the institutional investors are buying these renovated products for between $500,000 to $700,000 per unit. We sold a 2-family last year for over $1 million per unit. So I feel like the institutional capital is right there with where the market is at for condos. And
They are.
I think that's interesting from like a yield perspective, that on like the rental side of things, you can rent out a unit and generate enough yield to be competitive with the condo value as well. And Adam mentioned in Park Slope, we sold a property, an 8-family for $1,500 a foot. And I'm assuming that's probably in line with the condo market.
Definitely.
So
It's right there, yeah.
And you mentioned that was a 4.5 cap. So it's very interesting that where the rental market is generates enough positive cash flow and yield so an institutional investor can come in and buy it And basically, it makes more sense for the developer to go that direction than selling as condos.
I think in most aspects, a lot of these condo buildings are on the same level as what these institutional funds are paying as a rental. Anyone that's doing a project right now that's near completion or getting ready for their sales should definitely consult with someone that's selling these multifamily buildings in the area, because it's possible you might be able to do it in one clean swoop.
Yeah, we have a building in contract right now, and it's in Cobble Hill, and it's really interesting 'cause it's a 4-family building. The guy's paying like $800 to $900 a foot for it. And I asked him, I was
It's
like,
finished product?
No, it's unrenovated. And
It's vacant.
It's vacant. And I said straight up, I was like, what are you projecting for the condos? And he was like, I'm actually going to probably do high-end rentals because I'm projecting, call it $80, $90 a foot on the rental.
Wow.
And he's like, and there's also this institutional component that we had talked about. He's like, yeah, I could easily just exit right now in one full swoop after I renovate this thing in 6 months. And to me, that's when it really hit me that I was like, wow, this is like the institutional investors are changing the game. And then I think as the developers and the like active syndication guys that are raising money and buying buildings, like they're all catching on to this because it's a very clear exit. And instead of getting lucky to sell it to someone that hit the lottery or a 1031 buyer, it's you have the clear exit on either way, and there might be actually less risk in developing a rental property than a condo development.
So this comes back to what we talked about a couple weeks ago in terms of rents. So I guess the rents on the rental side of the business are that strong that, and the condo market must have pulled back enough that it makes more sense to do a luxury rental than a condo, and it might be just as worth it from like an equity standpoint.
Well, and here's what's interesting about that. After we discussed that, I went and clicked up and down every single building on that block. I was just curious. I was like, how many of these buildings are renovated? How many are not, right? And I'd say it's a very nice brownstone block, and the majority of them were like 1 and 2 families. Obviously, there's not a lot of rental information posted on StreetEasy. You can't tell if they're renovated or not. I wasn't going to do the deep dive on like where permits pulled, et cetera. Mm-hmm. But for the other multifamily buildings on the block, like next to none of them are renovated. So there's just not the product in the market for the renter. And I think so. Therefore, the demand for the renovated stuff especially in the core areas is just going bonkers.
That's the big thing.
Yeah.
In core areas, let's take a core Manhattan. Let's say the West Village, core in Brooklyn. Let's say Park Slope. There's a lot of old school owners that always got big rents. They don't have renovated product. You don't need to. Mm-hmm. You could get rents without renovating, versus other markets like, let's say, Lower East Side Manhattan, let's say Bushwick, Brooklyn. Like, you need to have like top of the line product, washer, dryer, dishwasher, gutted apartments. And these core markets, they don't have a lot of renovated product. They don't.
So how about interest rates coming into this whole play? Because are interest rates pushing cap rates up in this category, or just do the institutional investors have a different source of capital and they're not so tied to the bank rates that?
I think it's right there.
Yeah,
they're not tied.
Okay,
it's a different game.
So it's a different calculation.
They play a different game. They're on a different level.
It's
been unfazed. If anything, they've been paying more because of the rental growth.
Yeah.
So that's why they can pay more than the average guy.
Yeah.
So I want to get back to one more thing. So I think we've been speaking a lot about like free market renovated product under 10 units. Is that right?
Yeah.
But what about stuff where the developer went in, they redeveloped, say they did an alt 1. So they took a 3-family, they made it an 8-family, luxury rentals. They didn't want to get reassessed for tax purposes. They took out a J51. So let's talk about that example. And then I want to talk about 421A a little bit as well in terms of this whole conversation. So is J51 getting this kind of interest and demand, or any thoughts here?
It's not, I think, for 2 reasons.
Yeah.
Your rental growth is capped because you got to abide by the rent laws. Because as it's J51, it's stabilized for the time period. And I think the unknown, because after that J51 expires, it's hard to know what that building is going to be assessed and what the full taxes are. Like, you can make a good guess of what the full taxes should be today.
Yeah.
But what are they going to be in 15 years? What is the city going to assess that building at? It's almost impossible to tell.
It's also not just the assessment, though. It's there's inherent risk potentially with any change in like good cause eviction. Like it's a gray area, right? So if you have an abated deal and it's not expiring for 20 years, you're assuming that after the 20 years you get that next vacancy, it's free market, right? But what if they pass this good cause eviction bill and then therefore it's actually not free market and you actually can't ride that free market wave in the future. So it's a little bit of an unknown.
There's also a major disconnect between the sellers of J51 product to buyers. There's a huge disconnect.
So what's the disconnect?
The person with the J51 with taxes at $3,000, they pretend that that's not the case and that their income's X, and they don't like to talk about how their taxes are $3,000, and they think they should get the cap rate with the taxes that are in place, and it's never the
So
situation.
hang on. So just to clarify that, so the taxes are $3,000, but you're saying that's a real tax or not a real tax?
It's not real.
Why
it's
not?
It's not real. It's a ticking time bomb. It's like sitting around a circle throwing around a hot potato. I mean, every year I mean, that's what it is. You're the last. The closer you get to expiration, the hotter the potato, and you're the last person holding it. You're not gonna be able to sell it. So every year, the taxes are gonna you start to phase out, and they could go up.
So you're saying sellers want to price the deal on the abated low taxes, and they want to cap that out at like a 5 cap.
Yeah.
And buyers are like,
no.
Dude, I see your assessed value, I see your abatement amount, and your taxes aren't $3,000. I mean, it looks like it's $3,000. That's what you're paying, but really, you're only at $3,000 because you have this huge abatement, and the taxes are really $60,000.
And the longer you hold it, the more time that comes off the J51, and it's gonna get harder and harder to sell.
To be fair, I think a lot of buyers also don't take or give enough credit to the tax savings. So you basically have this standstill of people that don't really want to transact that.
All right, so we're saying the J51 buildings just aren't falling into this category, right?
No.
For institutional investor demand. And what about the 421A? Because we spoke about KKR, we've seen other institutional investors come in and buy very big buildings with 421As. So what are our thoughts on that business plan? I happen to like that business plan in one sense because it's a way to get scale quickly, and you're getting renovated or new construction I guess it's new construction product in that case. But on the other hand, I think what some of these other investors are doing by cobbling together these legitimately free market tax protected buildings, I think they're putting together far superior portfolios. So any thoughts on that?
Well, you said the scale. The scale on the 420A is interesting, and you take a fund like KKR. I mean, they're big. They're big on the new 421A, and they want to see a brand new spanking 421A that they have a long life on, and there's a lot of value there. You could have the rental appreciation could play a big role there too, right? Like
For sure.
they're interesting. I get why people buy the big buildings with 420As.
They have a
I get it.
70% free market component.
I get it.
Depending on the 421A.
But
I totally get that business.
But
plan.
I think the interesting about the 421 abated deals in the new construction is that the stabilized legal rent versus the the in place rent's obviously a lot higher. So if RGB comes out with a 5, 7, 8% increase, which I mean that hasn't been the case in a long time, but if they do come out with a big increase on the stabilized rents, like those are big pops for those deals. And I think that's what's interesting about the abated new construction ones as well.
So you think you're getting those for like a discount to what they'd otherwise be worth because you have the rent stabilized component and the 428 component?
Yeah, I think right now, like I do like those deals a lot because you get something that's rare, new construction, right? It's already signed off and it's operating, and then like if you get a little bit lucky with the changes in the legislation, you get the free market rent growth, and then if RGB comes out and you have bigger increases, like the cap rate's starting to look a little bit better on those.
You know what else is interesting? We're not seeing a whole lot of it. Is the new construction buildings that did not take a 421A. So it's just new construction. It's free market. No tax abatement. No rent regulation. High tax bills. So I mean, the taxes are going to be a beast on those. But those are big free market buildings. So that's interesting in this category as well.
Yeah, I mean that's a very desirable product right now. That's the dream deal. Big deal, 50 plus units, 30 plus units, no tax abatement.
Free market.
Yeah, free market.
So obviously, like the pendulum has swung so far into free market, and obviously, like a lot of these funds are buying into that. Like, what about the opposite? Like, do you think there could be institutional capital coming into the stabilized portion of the market on fully rent stabilized buildings at this point? And trying to gobble up just like portfolios and buildings.
No, the reason I say that, interest rates are too high. The only play with rent stabilization is if you have really low interest rates, and because of the rent laws change in 2019, there's this big push against it. So cap rates went up, right? The cap rates went up after 2019 for fully RS product. But there was a time, 2020, 2021, interest rates were very low, and there was a nice gap there. I don't think you'll see it. There's not a clean way to make money. If there's not a clean way to make money in an exit strategy, raised capital is not going to buy it because raised capital is raised to make money. Now, who's going to buy those deals? The huge operators that have owned hundreds of units in these areas that have family money that have owned this product. They're always going to own this product. And yeah, they're going to pick up a nice 50 unit that's near their portfolio, that's clean without violations. They're the buyers. But they're not looking to make money. They're looking to spend their cash flow and just buy out.
I think there's some fear factor there too.
Yeah.
The fact that landlords have been politicized in New York.
Yeah.
I don't think an institutional fund wants to get their name all over a 1,000-unit portfolio that's rent stabilized.
No, you do not.
And just the headaches what that entails.
Yeah, also when the tenants are calling HPD and there's nothing you can do and put violations on the building.
You
Like
saw it in Stuytown. Like I think that's just the end of an era.
And there's a few dead bodies in the road for people to look at. I mean, there was a time when you could exploit rent stabilized units before the rent laws changed, and there was a lot of funds that did it, bought this stuff up, bought all the tenants out, raised the rents, and a lot of them got hit for that, right? You know, tenant harassment, all this stuff. And they're not going back down that. It's too risky.
Not in New York.
It's too
Not
risky.
in New York.
No, that's a done business plan.
Okay, so I don't know if there's anything else you guys would like to add in terms of what we're seeing from institutional investors targeting buildings in New York City and predominantly Brooklyn and the smaller stuff.
I just think now's a really good time if you own one of these properties to really think hard of what you want to do.
Yeah.
I know there's a lot of investors that are long-term holders or developers that are, you know, it's their baby or they're in it to hold, but it is definitely something to at least understand what it's worth today and help you make a decision moving forward, because it could help you catapult into a whole nother category.
Yeah.
With the proceeds.
Yeah, I was gonna say, like, it's an excellent time to be a seller for vacant, unrenovated, vacant renovated, occupied renovated. Those are three very clear business plans where there's massive demand right now and liquidity in the market. Where if you do have the product and you own the product and you're open to exiting out of it and selling it, we can definitely put those deals together pretty quickly.
Yeah.
I think the valuations are like there and demand is quick, and there's huge demand for it right now.
Perfectly said.
Yeah, really good. So,
Yeah.
All right. So next week we're going to talk about what value add deals are in the market, what value add deals look like, what the avenues are, what the plays are. We're going to talk about substantial rehabilitation. We're going to talk about just how a owner in Brooklyn can take one of these small buildings and just where the juice is in those deals. So that's what we're going to talk about next week.
That's exciting.
Good.
Looking forward to
Anything
it.
else you guys want to add?
Yeah, it's great.
Okay, cool. That's it for today.
Thanks, guys.
And thanks for listening.
Perfect.